Most Americans believe they need to earn six figures to buy a house. The real number will surprise you, and not in the good way. Today, we're breaking down exactly what it costs to afford a house in 2026 at three specific price points: 500,000, 750,000, and $1 million. Real numbers, real math, no sugarcoating. Because here's the thing, most people are approaching this completely backwards. And by the end of this video, you'll know exactly where you stand and what the actual path looks like from wherever you are right now. Let's start with the state of the market because the context matters. The median home price in the United States as of early 2026 sits at approximately $429,000, according to National Association of Realtors data. Mortgage rates are holding between 6.3 and 6.6% on a 30-year fixed loan, according to Fannie Mae and the Mortgage Bankers Association. These rates are not dropping dramatically anytime soon. Most forecasts put them staying above 6% through 2027. Now, here's the number that reframes everything. According to Redfin, median home prices in America are currently 5 times the median household income. 5 times. In 1985, that ratio was roughly 2.6 times. So when your parents say they bought their house on one income, they're not wrong. They just bought it in a completely different mathematical universe than the one you're living in right now. This isn't a personal failure, it's a structural shift that happened over 40 years and landed squarely on your generation. So let's get into the actual math. The rule most lenders use is the 28% rule. Your monthly housing payment, mortgage, taxes, insurance should not exceed 28% of your gross monthly income. This is not a suggestion. This is what banks actually use to approve or deny your loan. If your payment pushes past this threshold, your application weakens significantly regardless of your credit score. There's also the debt-to-income ratio, or DTI. Most conventional lenders want your total monthly debt, including the mortgage, to stay under 43% of gross monthly income. If you have student loans, car payments, or credit card minimums, those count against this ceiling. They eat into how much house you can actually qualify for before you even start shopping. Now let's run the tiers. $500,000 home. This is the entry point in most major metro areas in 2026. In Los Angeles, the affordable home price for median income households sits at $421,000, according to GeoBanking Rates City data. In Phoenix, it's $403,000. So a $500,000 home is slightly above median income range in these cities, meaning most average earners technically cannot qualify for it without a significant down payment strategy. Here's what the numbers actually say. At a 6.5% 30-year fixed mortgage with 20% down, that's $100,000 up front. Your monthly payment is approximately $2,530 in principal and interest. Add property taxes averaging around $400 to $600 monthly depending on state. Homeowners insurance around $150, and you're at roughly $3,200 to $3,300 per month total. Apply the 28% rule. Divide $3,300 by 0.28. You need a gross monthly income of approximately $11,700. That's roughly $140,000 per year. Drop the down payment to 10%, $50,000, and you add PMI, private mortgage insurance, which typically runs $200 to $300 monthly on top of the higher principal payment. Your required income now pushes past $150,000 per year. Drop to 5% down $25,000, and between the higher loan amount, higher PMI, and potentially FHA mortgage insurance premiums, you're looking at a required income approaching $160,000 annually. Go banking rates and current mortgage data confirm this range most buyers need between $110,000 and $140,000 annually to responsibly purchase a $500,000 home with a standard down payment. Drop in the comments right now, does that number match what you expected, or did it surprise you? I want to see what people are actually thinking going into this market. $750,000 home. This is the reality in markets like Seattle, Boston, and San Diego, where median prices now sit in the mid to upper 400s, and move-up buyers are pushing into this range. At 6.5% with 20% down, 150,000 up front, your principal and interest payment is approximately $3,790 monthly. Add taxes and insurance in a higher value property market, and you're easily at $4,500 to $4,800 per month. Required income at 28%. Divide 4,800 by 0.28. You need approximately $205,000 per year in gross income to comfortably qualify. That is not a typo. $200,000 plus per year for a 750 house. This is why dual income households exist not as a lifestyle choice, but as a mathematical requirement in most coastal and major metro markets in 2026. And here's what nobody talks about. The down payment problem is actually worse than the income problem at this level. 20% of 750 is $150,000 in cash. After taxes, sitting in your bank account ready to wire, most Americans, including high earners, do not have $150,000 in liquid savings. The gap isn't just income, it's liquid capital, which takes years to accumulate even on strong salaries. $1 million home. San Francisco, New York, parts of Boston, Austin's premium market, South Florida's waterfront zones. At 6.5% with 20% down, 200,000 in cash up front, your principal and interest runs approximately $5,055 monthly. Total with taxes and insurance in these markets easily clears $6,000 to $6,500 per month. At 28%, you need a gross monthly income of approximately $23,000. That is $275,000 per year. This is not a normal salary. According to IRS data, fewer than 2% of American households earn above $250,000 per year. The $1 million home market in 2026 is structurally limited to a tiny percentage of earners or to people who already own significant equity from previous properties. Now here's the part that's actually useful. 4 levers exist that change these numbers. Understanding them is the difference between being locked out and finding a realistic path in. Lever 1: down payment size. More down means lower. Monthly payment means lower income required. Every additional 10% down meaningfully shifts the qualification threshold. Get to 20% and you eliminate PMI entirely, saving $2,000 to $4,000 annually. Lever 2: debt reduction. Every $100 of monthly debt you eliminate through payoffs, student loans, car payments, cards, adds roughly $400 of home buying power because of how DTI calculations work. Aggressively paying down existing debt before applying is not optional in this market. It's strategic. Lever 3: location flexibility. The affordable home price for median income households in Las Vegas in 2026 is $354,000. In Charlotte, it's $368,000. Where San Francisco sits at $581,000, Charlotte buyers need roughly a third of the income. Remote work has made this lever more accessible than at any point in the last 30 years. Lever 4: credit score optimization. The difference between a 720 and a 780 credit score on a $500,000 mortgage can be 30 to 50 basis points in rate. On a 30-year loan, that difference costs, or saves, $20,000 to $40,000 in total interest. Credit score isn't a vanity metric. It's a financial instrument. Here's where we land. Affording a house in 2026 requires more income than most people expect, more cash than most people have saved, and more planning lead time than most people give it. The median American household earning the median income cannot comfortably qualify for the median home price in most major markets right now. That's the structural reality, and pretending otherwise doesn't help you. What helps is understanding exactly which lever applies to your situation and moving on it now rather than waiting for rates to drop to a level that may never arrive. The math doesn't move, but you can. This is what Scott Finance is here for every single week. Not reassurance, the actual numbers. Subscribe, because the people watching this channel are the ones who actually do something with the information. Hit the button